In the last video, we tackled half of this LOS on forward commitments and contingent claims. There, we spoke about forwards, futures, and swaps. In this video, we're going to tackle the other half and talk about contingent claims, options, and credit derivatives. The key difference between this section and the previous section is the action on settlement date. With a forward commitment, both parties are obligated to fulfill the terms of the contract. The long party is committed to a purchase, and the short party is committed to a sale. The only way out is to book an opposing contract or default. With a contingent claim, the writer of the contract is still obligated to fulfill the terms of the contract, but the holder of the contract has the right to do as they please. They may choose to exercise their right or allow the contract to expire. Options contracts gives the holder the right to take some kind of action in the future. Here we are looking at options which give the holder the right to buy or sell an asset in the future at some predetermined price. There are two parties to an option contract, the writer and the holder. The option holder, the long party, has the right to take some action, if they wish, whereas the option writer, also known as the short party, is obligated to fulfill their side of the contract. An option premium is the amount paid by the holder to the writer at the outset, which works the same as an insurance premium. The writer receives the premium to obligate them to fulfill the contract, similar to the obligation of an insurance company. The holder pays the premium to be in a position to make a call in the future. The strike price of an option is the predetermined price locked into the contract, often denoted with a capital K. This is the price that settlement is based on, the price that the holder can buy at or sell for in the future. Now, before I talk about the different kinds of option and how the most basic trades work, let's just be very careful about the usage of two words, payoff and profit. You need to remember that payoff is the amount of money we earn or lose from holding the option position. Profit, on the other hand, is the net return, the earnings after consideration of costs. Okay, the right to buy an asset is called a call option. If I am the holder of a call option, I have the right to buy some asset at some predetermined price in the future from the option writer. The writer here receives the option premium in initiation, but from then is obligated to fulfill the sales side of the trade if the holder chooses to exercise the option. The call option holder is hoping that the asset price will rise. If it does, they can buy from their counterparty at the option price and sell in the market at the higher market price. The profit structure to the holder of a call option looks like this. On the y-axis is the amount of money the holder stands to gain or lose depending on where the underlying price lands on the date of expiry. The x-axis tells us the price of the underlying at the date of expiry. The payoff to the call option holder looks like this. Remember that a call option is a bet on the price rising, so if the underlying price falls, the option holder will allow the option to expire worthless. It is important to realize at this point that no option payoff will ever be lower than zero. Now, in the event that the price does rise, however, the payoff will be ST minus K, the underlying price at time t, minus the strike price of the option. Okay, so back to the profit graph. The kink in the curve, here, marks the strike price of the option. If the price of the underlying is exactly this value at expiry, then the option payoff, given as ST minus K, will be equal to 0, and the profit on the position will be equal to 0 minus the premium, which means a net loss equal to the value of the premium. Now, if the price of the underlying lands in this area at option expiry, then the option will expire worthless. Why? Because in this area, ST, the price of the underlying at time t, will be lower than the strike price, indicating a negative payoff. But remember, no option holder will ever exercise an option for a negative payoff. So for any ST anywhere in this area, the profit will be the same, a loss equal to the amount of the premium. Now, on the other hand, if the price does rise up to this area above the strike price, then the payoff is given by ST minus K, which will be some positive value, and the profit, given by payoff minus premium, will be some amount higher than the loss of premium from before. It may still be a loss, up until the point where the option payoff is positive in an amount equal to the value of the premium, but it still means that the option will be exercised. The right to sell an asset is called a put option. If I am the writer of a put option, I have given the holder the right to sell some asset at some predetermined price in the future. If they choose to exercise the option, I am obligated to buy from them. As the holder of a put option, if the price rises, the option expires worthless and I lose the option premium. If the price falls, I can buy at a new lower market price and sell at the contracted option price to make a profit. The payoff to a put option holder looks like this. Remember that a put option is a bet on the price falling, so if the underlying price rises above the strike, the holder will allow the option to expire worthless. The option cannot have a negative payoff. The profit structure to the holder of a put looks like this. Again, the kink in the curve marks the strike price of the option. And again, we have two distinct zones. To the left of the strike price, the option will be exercised and return some payoff to the holder. To the right of the strike price, the option expires worthless, and the profit to the holder is a loss in the amount of the option premium. Okay, now before we move on, let's not forget that the date on which the option holder can exercise their right depends on the type of option involved. American options can be exercised at any time before their expiry date, but European options, on the other hand, can only be exercised on their expiry date. Prior to a short couple of decades ago, credit risk management was the simple case of performing due diligence on a borrower prior to lending and keeping an eye on them during the term of a loan. This has been revolutionized in recent times with the advent of a series of products called credit derivatives. Credit derivatives are instruments with payoffs based on credit events, so they are used by market participants to transfer credit risks without selling out of a position. Here's a quick list of the types of instruments we're going to cover: total return swaps, credit spread options, credit-linked notes, and the core of the subject, credit default swaps. Okay, first we have the total return swap. This is a nice simple idea. Let's say I'm a bond holder. I am receiving cash flows from the bond issuer, so therefore I am exposed to the risk that this issuer will be unable to continue making these payments. A total return swap seller will agree to take on the risk of this default. The original bondholder pays this new party the entire return on the bond, and in return, they receive a newly agreed fixed or floating rate. In the event that the bond issuer does default, the total return of the bond will be zero, but the swap seller will still be expected to continue their payments. Next, we have credit spread options. What you need to remember here is that the yield spread between a bond and the relevant benchmark is an indication of credit risk. These options have a yield spread as their underlying, so it's like insurance on changes in the market's perception of credit risk for a certain issue. Remember that the payoff of a call option is equal to either zero or the difference between the strike price agreed in the contract and the price available in the market. In the case of a credit spread option, the strike price is the yield spread specified in the option contract. The market price is the yield spread on the date that the option would be exercised. Okay, next we have credit-linked notes. This is similar to a total return swap. Again, here we have a bondholder who is no longer willing to accept the credit risk exposure of the issuer. In this case, rather than going out and buying a swap contract, the bondholder is going to issue their own debt security. Now, we won't go into too much detail here on the actual structure of these deals. In reality, there are some more steps and parties involved, but for CFA Level 1, we need to understand the basic setup in terms of risk exposure and how the risk is transferred from those who have it to sell to those who want to buy it. Enter the CLN investor. This party invests some principal amount with the bondholder, and the original bondholder agrees to pay a new rate plus the principal repayment at maturity. Now, what makes this a credit derivative is that the amount of the principal repayment is going to be dependent on the original bond. If the original borrower defaults on their issue, then the principal to be repaid to the holder of the CLN will fall. So if the original flow of bond return drops away, we won't be liable for as much of the principal repayment to the CLN holder. Finally, then, we need to look at credit default swaps. A CDS is the clearest form of credit insurance. The setup is the same as with the rest of the credit derivatives. Now, one thing I have found across both the CFAI textbook and other sources available in the market is the interchanged use of bondholder and issuer and lender and borrower. So I'm going to do that here for completeness. A bondholder could also be referred to as a lender, and an issuer could also be referred to as a borrower. Some students fail to recognize that because they would assume that the icon for a building would relate to an institution who is lending. It's not. It's intended to signify a company who has sought debt financing. Okay, so with a CDS, the lender pays a periodic premium to the swap seller. They effectively trim the amount they are earning on the bond so as to transfer some or all of the credit risk. Just like with insurance, if no credit event occurs, then the swap seller receives these premiums and never has to pay out. It's when the credit event occurs that the swap seller is liable for a certain pre-agreed payout to compensate the CDS holder.